Ever dreamed of steady monthly cash flow without trading hours for money? Yet every passive income guide you find feels unachievable or full of hidden risks. You grind a full-time job, live paycheck to paycheck, save relentlessly, but still can't build reliable extra income. You've heard dividend stocks can generate recurring payouts, but you're stuck with endless confusing questions. How much money do I actually need to hit $1,000 monthly dividends? Can dividend yields beat inflation long-term? Which stocks and sectors deliver sustainable high payouts worldwide? How do compound dividends speed up wealth growth? And what dangerous dividend traps should I avoid at all costs? Today, Bill will break down a complete, actionable roadmap to build a steady $1,000 monthly passive dividend portfolio, covering exact capital targets, globally diversified asset mixes, top high-yield sectors across international markets, compounding math, low-effort ETF shortcuts, and critical hidden risks most beginner investors overlook. Imagine earning $1,000 every single month completely passively. No overtime work. No side hustles. This is the core promise of passive income. And one of the most accessible long-term passive streams comes from building a globally diversified dividend stock portfolio. Many new investors wonder how this dividend strategy works, and whether consistent monthly dividend cash flow is realistic or just too good to be true. When you fill your investment portfolio with dividend-paying equities, you create an automatic recurring income stream that lasts well into retirement, with regular cash deposits landing in your bank account without ongoing labor. Dividend stocks are shares of publicly listed corporations that allocate a fixed portion of their quarterly or annual net profits directly to all shareholders. If you hold a balanced portfolio of these reliable dividend issuers across different regions over decades, you unlock predictable, lifelong passive income. The biggest question every new income investor asks: what total capital do I need to generate $1,000 in monthly dividend payouts? The honest answer is a substantial lump sum, which is why early, consistent investing drastically shortens your timeline to hit this passive income milestone. You can begin your dividend journey with modest starting funds, a $20,000 initial investment, plus steady $600 monthly contributions over a 15-year holding window. Combine global government and corporate bonds, high-quality international dividend equities, and real estate investment trusts, REITs, for broad cross-market diversification, targeting a baseline 5% average annual dividend yield by fully reinvesting every dividend payout back into your portfolio and capturing an extra 1 to 2% annual capital appreciation from slow stock price growth. Your blended total annual return lands between 6.5% and 7%. Running the 15-year compound calculation, this disciplined investment plan grows your total portfolio value to $240,000. Multiply this $240,000 asset base by the 5% average dividend yield, and you receive $12,000 in total annual dividends, equal to $1,000 in monthly passive dividend income. Inflation silently erodes your purchasing power year after year. $1,000 of cash today will buy far fewer goods and services 1 decade from now. For this reason, every dividend portfolio you construct must target stocks with a sustainable 5 to 6% annual dividend yield to outpace inflation consistently. Inflation spiked to 45% in recent years across most developed nations, but historical long-term average inflation hovers at 23% globally. Any portfolio generating steady 5-6% dividend returns will reliably preserve and grow your real purchasing power over time. Financial experts highlight 3 high-yield, low-volatility sectors available in nearly every major global market that easily hit the 5-6% yield target, even with projected future interest rate cuts. First, large established banking conglomerates deliver stable near -5% annual dividend yields, with resilient balance sheets and consistent profit distributions, regardless of region. Second, publicly traded REITs regularly exceed 6% dividend yields worldwide. Top liquid varieties cover commercial, industrial logistics, and retail real estate, all offering 5 to 6% recurring payouts backed by long-term property rental revenue. Third, mature telecommunications giants maintain steady dividends across every continent, with average yields ranging from 5.2% to 5.5%. Never limit your portfolio to stocks from just one single country. Adding reputable blue-chip dividend companies from multiple regions slashes concentration risk by spreading your capital across dozens of geographic markets. Bill strongly recommends a dual diversified allocation strategy. Split your funds between US dividend assets, European and international global dividend stocks, paired with stable domestic income stocks from your home country, to balance risk and boost consistent long-term returns. Compounding dividend reinvestment is the single most powerful tool to accelerate your passive income timeline. Compounding means automatically funneling all dividend cash payouts back into purchasing additional shares of your existing portfolio, expanding your total asset base and raising your future annual dividend payments exponentially. We will walk through a clear math example to demonstrate this compound growth effect. Suppose you start with a $10,000 initial investment at a flat 5% dividend yield. Your portfolio generates $500 in dividend cash during year 1. If you contribute an extra $12,000 annually, $1,000 per month, your new total capital pool at the start of year 2 equals your original $10,000 base, $12,000 yearly contributions, and $500 reinvested dividends, summing to $22,500. Applying the same 5% yield to this larger $22,500 balance delivers $1,125 in year 2 dividends. Repeating this reinvestment and monthly contribution cycle for 15 consecutive years results in $12,749. In total year 15 dividend payouts, averaging exactly $1,000 in monthly passive dividend income. Building a hand-picked individual stock dividend portfolio demands extensive global market research, financial statement analysis, and weekly monitoring time. If you lack spare hours to track dozens of separate stocks across different exchanges, exchange-traded funds, ETFs offer a low-effort alternative. Global dividend ETFs hold hundreds of income stocks from all over the world in one single investment product, featuring ultra-low management fees and built-in cross-industry, cross-country diversification to lower overall portfolio risk. 2 core terms for income. Focused investors are dividend aristocrats and dividend kings. Dividend aristocrats are corporations that have raised their annual dividend payouts for 25 straight years, while dividend kings maintain consistent dividend growth for 50+ years. These elite dividend firms exist in the US, Europe, Asia, and other developed markets. Researching them requires heavy due diligence, so beginner investors can skip individual stock picking entirely by buying diversified global dividend ETFs or managed income funds. Instead, dividend stock investing carries meaningful hidden risks all new investors worldwide must learn to avoid. The most dangerous pitfall is the dividend trap. Stocks with artificially inflated high yields that cannot be sustained long-term. Many struggling firms with weak core business fundamentals borrow large sums of debt just to fund dividend distributions. When a company slashes or suspends its dividend, its share price almost always crashes sharply, a clear warning sign of deteriorating financial health. Dividend growth is never linear or guaranteed. During recessions and broad economic downturns across the globe, even historically reliable businesses will cut dividend payments to preserve operating cash flow. Dividend payout timing also creates uneven monthly cash flow. Most listed corporations close their fiscal year in March or December, releasing dividend disbursements, primarily in May, August, and September. This creates months with zero dividend income and months with large sum dividend deposits, making monthly cash flow inconsistent without careful planning. While dividend-focused businesses deliver stable, predictable returns, they rarely match the explosive long-term price growth of pure high-growth technology and innovation companies. High-growth firms reinvest all operating profits back into expanding their business operations rather than distributing dividends to shareholders, which drives faster share price appreciation. Always avoid stocks with extreme weekly price swings. Premium dividend income stocks feature slow, steady price movement with minimal volatility.